MannKind, MNKD, has now accomplished 3 consecutive weeks with Afrezza script sales above the 500 level. The sales of Afrezza are showing modest progression, which is certainly better than the alternative, but remain off the needed pace to deliver the level of confidence to the street that can deliver equity appreciation. Chart source: Spencer Osborne, based in part on Symphony data. For WEEK script growth with the numbers this week, we are now at another 4-week data point in tracking script progress. Script sales for the last 4 weeks were 12.62% better than the data point prior. This represents the second-best 4-week script growth percentage that the company has seen since it took control of Afrezza sales in almost 2 years ago. Positive growth numbers are imperative for Afrezza. Chart source: Spencer Osborne, based in part on Symphony data. For WEEK retail sales growth, the 4-week retail sales growth came in a bit more modestly than the script growth. Retail sales grew 0.47% over the previous data point. As I have expressed readers in the past, sales figure growth will more closely track to script growth in 2018. The reason for that is the new packaging is fully integrated into the system now. Chart source: Spencer Osborne, based in part on Symphony data. Rolling retail sales. Tracking the rolling sales numbers allows investors to see the dynamics at play with scripts. Reported scripts are not all-inclusive in that there are some 3-month scripts within the numbers. This can be clearly seen by looking at the retail sales dollars per reported script. What we see in the Symphony data is retail sales of $1,200 to $1,300 per reported script. Knowing that the most expensive Afrezza pack, one of the titration packs, is about $1,200 and a refill can go for just $600, it is clear that the retail sales numbers would include multi-month scripts. Investors should expect the average revenue per reported script to stay relatively flat in 2018 unless there is a price increase in Afrezza. Chart source: Spencer Osborne, based in part on Symphony data. Quarter-over-quarter scripts. On a quarter-over-quarter basis, Afrezza scripts are pacing 16.72% better than what was delivered in Q1. This is indeed a positive number, but not very exciting when you consider that a bigger growth number is needed to impress the street as well as hit MannKind's net revenue guidance. The current quarter is flirting with the best-ever script tally, inclusive of when Sanofi NYSE SNY was driving sales. Chart source: Spencer Osborne, based in part on Symphony data. Year-over-year script growth. The year-over-year numbers present some great talking points for MannKind, albeit a bit shallow. The news cost and direct sales force are factors that investors need to consider. The main reason that these talking points are shallow is that even with what appears to be great progress, the current numbers remain less than impressive. Understanding that Afrezza sales are at about 10 scripts per week per state underscores the concerns many investors and potential investors have. At this stage, Q2 of 2018 is pacing 74.31% better than Q2 of 2017. Chart source: Spencer Osborne, based in part on Symphony data. Projections and estimates. I offer readers projections and estimates. The projections are my outlook into where sales will be, while the estimates are building in the known sales data as it occurs each week. Investors should look at the projections to look further down the road, and the estimates to assess the current quarter. Script sales are still tracking below my projections, but remain within striking distance. I have termed my projections as being aggressive, and readers should consider that when assessing the numbers and data. Chart source, Spencer Osborne. Based in part on Symphony data, looking at the revenue numbers, projections, and estimates, we can see that the net revenue per reported script is also tracking below my projections, while retail sales and gross revenue are getting more in line. The reason for this dynamic is the monies that I anticipate that MannKind will need to use to support sales. Chart source, Spencer Osborne. Based in part on Symphony data, perhaps the best way to look at all of this is in the chart below. You can see by this chart that 40% of the year has passed and that estimated net revenues are at about the 28% mark. This would imply that estimated sales are lower than the outlined pace of the projections. At this point, I estimate that 2018 net revenue from Afrezza sales stands at about $5.8 million. For Q2, I have net revenue at $2.4 million with 5 weeks to go. Q1 of 2018 delivered $3.4 million in net revenue. I estimate that Q2 will deliver net revenue of about $4.10 to $4.3 million in net revenue. This would imply a first-half net revenue total of between $7.5 million and $7.7 million. The importance of this net revenue number will be discussed in the guidance section below. Chart source, Spencer Osborne. Based in part on Symphony data, MannKind guidance. MannKind issued guidance for 2018 at the end of February. The guidance was for net Afrezza revenue to be between $25 million and $30 million and for cash burn to be between $90 million and $100 million. If you think about this in a very logical manner, you can see a bit of why I have concerns about the guidance. Sales thus far in 2018 are pacing below the guidance. One way to increase sales is to spend more money marketing. The problem with spending more money is that it could put the cash burn guidance in jeopardy. The chart below shows the trajectory that was needed for MannKind to hit its guidance at the time the guidance was made, and the fact that actual sales are well below those lines. The problem is this: each week the company is below this line means that the steepness of the growth curve needs to increase. Chart source, Spencer Osborne. Based in part on Symphony data, looking at the pure numbers, we can see the problems. Estimated net revenue is at just 23% of the required levels, with 40% of the year having passed. As discussed earlier, I estimate that net Afrezza revenue for the first half of the year will be about $7.5 million. This would imply that the final 26 weeks of the year will need to deliver $17,500,000. Let's boil this down to simple terms. The first half of the year averaged $288,000 in net revenue per week. The second half of the year needs to deliver $673,000 per week. In looking at this in terms of scripts, the second half of the year will need to deliver about 29,000. Chart source, Spencer Osborne. Based in part on Symphony data, it is my opinion that the street-savvy investors, and potential offering investors will be looking at the guidance very closely and making a determination as to how likely meeting that guidance will be in the next few weeks. Some investors feel that the ADA conference and the data from the STAT study will be a big driver. While these are net positives in the grand scheme, I do not think the story is compelling enough to push sales that far up that quickly. In my opinion, MannKind was aggressive on its guidance because the company knew it needed to raise money. It is easier to raise money when you have a compelling story. Offer guidance that is too low and it makes raising much-needed capital more difficult. Now that 13 weeks have passed since the guidance was offered, the challenges of meeting that guidance are becoming more clear and more obvious. With the Q2 call most likely being in August, the company has about 12 weeks before it must address this issue head-on. If the guidance is going to be adjusted, it will not be a good selling point in raising capital. This, in my opinion, makes the window of opportunity somewhere in the next 8 weeks or so to do a capital raise. I will discuss that in more detail below in the cash segment of this article. Cash. It is said that cash is king. There is a lot of truth to that. A MannKind that is flush with cash can maneuver in a much different way than a MannKind that is living the corporate version of paycheck to paycheck. I estimate that MannKind finished the week ending May 25 with about $44.4 million in cash. This estimate does not consider any possible use of the ATM facility. I estimate that MannKind will finish Q2 with about $35 million in cash. Further, I estimate that unless capital is added, that the company will not be able to comply with the Deerfield covenant, which requires the company to possess at least $25 million in cash at the end of any quarter. The 14 million warrant shares priced at $2.38 that could bring in $30 million are not exercisable until mid-October. The conundrum is simple. How does MannKind get into compliance with Deerfield for the end of Q3? Negotiate with Deerfield to relax the covenant. Negotiate with Deerfield on the $15 million in principal due in July. Use the ATM facility to generate at least $10 million of potential shortfall. Preserve cash by negotiating with insulin supplier Amphastar partner. Increase sales very substantially in Q3. Sale, leaseback of Connecticut facility, need to negotiate with Deerfield, another share offering at debt. The bottom line is simple, and management has even indicated this themselves. MannKind needs another $25 to $30 million to get through the end of the year. The chart below assumes that shares are used to handle Deerfield debt. Currently, the use of shares to pay the debt is at the option of Deerfield and at a price of $3.25 per share. Deerfield would have no interest in taking shares at $3.35 when the market price is just $2. If, and that is a big if, Deerfield were to take shares at $2 each to pay the $15 million due in July, that would be dilution of 7.5 million shares. If the company uses cash to pay these notes, it will run out of cash at the beginning of Q4. Simply stated, the cash overhang on MannKind is a massive cloud over its head. There is no easy way to address it, and the most logical methods are not very shareholder-friendly. Addressing this issue could put the exercising of the $2.38 warrants in jeopardy as well, as such moves would tend to depress the share price. The warrants that might raise $30 million are a bit toxic to investors as well. Should the stock price make a run prior to mid-October, the savvy play for the holders of these warrants is to short. Let's assume the stock runs up to $3 per share on 8 news and press releases. Those warrant holders could sell 14 million shares short, collect $42 million and then wait to cover with either the warrant shares or from the market. Covering with the warrant shares would put cash into MannKind coffers, whilst covering on the open market would not. The danger is if we get to mid-October and the share price is below the warrant exercise price of $2.38. The bottom line is that cash remains a big issue with MannKind, and if MannKind cannot maneuver with shares, the cash crunch is even bigger. Chart source: Spencer Osborne. Summary: investors need to pay very close attention in the weeks ahead. Critical dates are as follows: June 22, data conference and release of stats study on hypoglycemia data. End of June, approximately $2.7 million due to Amphastar. Early July, payment of $15 million of principal to Deerfield. End of July, out of compliance with Deerfield covenant, if cash is used to pay $15 million. Mid-August, out of compliance with Deerfield covenant, if shares are used to pay the $15 million. Mid-August, Q2 conference call where it is possible guidance will need to be addressed head-on. Given the dynamics outlined above, it is clear that the best possible time to raise some needed cash is leading into the ADA conference. That is just a few weeks away. Raising the cash is critical, but investors need to grasp the way these things usually work. The buyer is usually getting shares at a discount, and in many circumstances can short ahead of the offering closing on the press release blitz to maximize share price. Warrants offered in any deal can have their own toxic effect later down the road. MannKind remains a speculative play. Active traders still carry the advantage. There could be a longer-term play, but the next several weeks are critical in determining that. Stay tuned. Disclosure: we have no positions in any stocks mentioned, and no plans to initiate any positions within the next 72 hours. I wrote this article myself, and it expresses my own opinions. I am not receiving compensation for it, other than from seeking alpha. I have no business relationship with any company whose stock is mentioned in this article.